Hello there, welcome to this edition of Global Business Africa. In the next half hour, I'll make a speed run through the key business news stories you need to know about today, especially. It's today when you're seeing a lot of red ink right across the markets. We'll let you know exactly what has happened, what's causing the fall, can you profit from it or should you cut your losses? Global Business starts right now. Exactly how much of African economy is lost in illegal financial flows? We'll be looking at the latest numbers from GFI. Zimbabweans believe that their country will soon join Africa's fastest growing economies. Are they justified? And a Ghanaian innovator is using regular, ordinary, everyday materials to power up his neighborhood. His story will be coming up shortly. Now, we'll get around to the bloodbath in international markets a little later, but let's start tonight with a long-standing problem of illicit financial outflows. Now, in real terms, the amount of money that's been hemorrhaging out of sub-Saharan Africa since the global financial crisis has just continued to grow. A study by the Global Financial Integrity Group shows that $68.6 billion flowed right out of sub-Saharan Africa through trade misinvoicing in 2012 alone. Now, that, of course, was lower than the peak in 2009 of $75 billion, but it was higher than the figures for 2010 and 2011. Now, over half of the $528.9 billion in estimated illicit financial flows from sub-Saharan Africa came from just two countries. Between them, Nigeria and South Africa each had over $100 billion in cumulative losses between 2003 and 2012. Globally, the volume of illicit financial flows is growing at the fastest rate in the Middle East and in North Africa. In 2003, the region accounted for just 2% of such outflows. By 2012, over 11% of the year's total flows. Now, at $727 billion, illicit flows from this region are almost 40% higher than those from sub-Saharan Africa. Between 2003 and 2012, however, the bulk of illicit financial flows came from Asia, developing countries in Europe and the Western Hemisphere. Between them, the Middle East, North Africa and sub-Saharan Africa accounted for less than 20% of the total cumulative outflows. Disappointing numbers all round. Let's expand this conversation now and reel in Daniel Rangers from Washington for a little more insight into this particular report. Daniel, this is the sixth such report from GFI, and the numbers just keep getting bigger and bigger every year. Have you had any reactions to this report in Washington?
Well, Rama, the very shocking thing about this number is that it is essentially, according to the report's authors themselves, only the tip of the iceberg, because the way they work it out is they look at the reported numbers that countries give to the IMF. So that's reported numbers in terms of their domestic fiscal government situation and also their trade data. And they compare that with discrepancies reported by other countries, especially on the trade data side. So it doesn't include things like criminal networks. It doesn't include cash transfers. It doesn't include wire transfers that are not reported to governments or not reported by the governments to the international community. So this is very much the tip of the iceberg. The shocking thing for Africa, sub-Saharan Africa in particular, that is that it is at the top of the list in terms of percentage of GDP. 5.5% of GDP, this organization has worked out, simply cannot be accounted for.
Indeed. Daniel, explain to us why G20 countries have been so resistant to some proposals that would ideally help curb some of these flows, like country-by-country reporting of both taxes paid and sales.
Well, it's pretty simple when you break it down. This organization is there to try to bring more transparency to the system. But the system itself is geared towards those who benefit from the system in its status quo. So though the G20 and other international organizations like the OECD have said we need to really tackle this on a global level, otherwise people will just compete to the bottom. Nonetheless, most of the people who look at this issue say their efforts are mostly window dressing at this point. Because at the end of the day, though countries report their data to each other and they look at some of these issues, they do not publish it. They do not publish it, so we do not know what the data shows us. We do not know how these transfers are taking place, and therefore there's no incentive for governments, for example, that engage in high levels of corruption to properly report what they're doing. And the countries that benefit from this corruption, the countries that are essentially tax haven, which includes many of the wealthy countries, have no incentive because their financial communities are strong and they simply don't want it.
Indeed. We'll have to leave it there for the time being. That's Daniel Rangers there live in Washington, D.C. We'll, of course, be talking to the authors of this report later on tomorrow in the Wednesday edition, of Global Business Africa. Let's take it to Egypt now. The government is being pressured into implementing legal and bureaucratic reforms well ahead of a crucial investment conference that's due to take place in 2015. The World Bank director, Halle Bridi, says it's time for Egyptian officials to go beyond just talking and actually do things to convince investors that they are actually dead serious about what they're talking about. The government has said for months it would amend investment regulations and create a one-stop shop to help foreign investors avoid the country's red tape. Investors, however, are concerned that so far they've just seen general outlines of reforms and they're calling for details and actual implementation before they part with their money. Now, Egypt is aiming to increase economic growth to about 6% within 5 years and to also cut its budget deficit within that period to about 8.5% of GDP. Oil fell under $59 a barrel for the first time since May 2009, following reports of a fall in industrial activity in China, the world's second largest consumer of black gold. International benchmark crude prices have almost halved since reaching a 2014 high of about $115 a barrel in June, on ample supply from American shale and weak demand from China, other emerging economies, and of course a slowdown in Europe. Now, oil producers do continue to feel the pinch after the Organization of Petroleum Exporting Countries reiterated that they would not try to shore up the oil price by reducing production. As far as Saudi Arabia and her allies are concerned, the market will rebalance itself. The oil cartel mentioned they're not targeting a price, they'll just sit back and let the market sort things out. Now, this slide in oil prices to new 5.5-year lows elicited mixed reactions across various markets globally. Here's a walk through the bloodbath. Asian markets headed low on Tuesday as the dip in oil prices heightened global growth fears and weighed on investors' risk appetite. Japan's benchmark Nikkei 225, that was down at its lowest level since the 31st of October. Data showing China's manufacturing activity contracting in December weighed on shares in Hong Kong. South Korean shares followed suit. They fell, closing just above a 2-month low. In Australia, shares closed at a 10-month low. Falling commodity prices dragging down resource stocks over there. Over in the United States, the S&P 500 traded below the 2,000 level for the first time since the 30th of October. As you'll see in a bit, African markets were also certainly not spared from the damage. Let's take it to Zimbabwe now. After more than a decade in recession, some Zimbabweans could soon be ushering in a new economic era, at least if any recent analysis of things down there, anything to go by. A number of articles do suggest the country could be one of the fastest growing economies in Africa in the next 5 years. But is that optimism really justified? Farai Mokutia caught up with one of the authors of these articles and spoke to someone in the trenches who's actually putting their money where their mouth is.
Many here are unemployed, battling to make ends meet and low on confidence. But all that's set to change, according to Bernard Broni, a UK-based economic analyst who's boldly predicted that Zimbabwe will be Africa's next economic giant. How? Leveraging its resources, both natural and human, its decent infrastructure, and crucially, its agricultural sector, which is on the rebound.
You need to have a good agricultural base for you to transform your industries. It's only not FDI which can transform economies, as you are aware. We are looking at value addition and beneficiation of our resources.
That's one of the things the government will focus on under a 5-year economic recovery plan, which, if successful, could see this become the hottest economy in SADC, according to another economic commentator who's also published an article touting Zimbabwe's promise. Clearly, there is growing sentiment that this country's economic fortunes could turn dramatically. But is that view only held by Zimbabweans observing from afar, sitting behind their laptops? Not so, according to this fashion designer. She's betting on things getting back on track again, and that's why she's launched her own clothing line, despite the naysayers.
I can't wait for things to be perfect here. You just have to make a go of it. And I think the market is waiting for it, so whether the economy is good or not, we just have to carry on.
Kaylee's starting small, keeping her costs low as she builds her capacity. But she has big dreams.
I would like to have a shop here and supply, first of all, Zimbabwe and then export to the rest of Africa, and to really get the fashion industry in Africa on par and able to compete with the rest of the world.
Her enthusiasm is clearly infectious and has rubbed off on her only employee for now, a 10-year veteran of the industry.
I think I'm going to grow now because this time we start, our country, there's no money to do the business. That's why there's a problem. But I think now we are going to grow.
Kaylee, like other clothing manufacturers here, struggles to get a steady supply of quality fabrics, which could be someone else's window of opportunity. And that augurs well for the entire economy that's been called on to open doors for emerging enterprises.
If you widen the base, then you're more likely to have a better results economically.
The world should watch this space for brand Kako's rise, just like it should look out for Zimbabwe's burst back onto the economic scene. Farang Makutuya, CCTV, Harare, Zimbabwe.
Right then, quick run through the markets here for you. The bloodbath does continue. A full set of red numbers right across the board. The Nigerian All-Share Index. The All-Share Index was down in the 30,000 points for the first time in about 2 years, if memory serves me right. And the rout continued right across the board. Keep in mind, however, the figures you're going to see about Egypt, down 3.58%. That's a knock-on effect from what we've seen in the Middle East. The Saudi main index was down about 7.3% in trading today. That's the biggest one-day drop we've seen from that market in about 6 years or so, and it's all driven entirely by the decline in Brent crude. So if you're a business owner in Liberia, how exactly are you staying afloat? We'll be live in Monrovia shortly with some answers.
Effects of the austerity measures are evident and were expected. Egyptians, however, seem to be patient about it. But El-Sisi told government he wants to control the prices promptly before people's patience runs out.
Welcome back to the program. You're still watching Global Business Africa. On the day, $49 billion was wiped off Gulf indices right across one day. Let's take you to West Africa, however, to ground zero for the Ebola outbreak. It does continue to have a fairly negative impact on the economies of Guinea, Sierra Leone and Liberia. The World Bank estimates that the total fiscal fallout will be well over $500 million, and that's in 2014 alone. Liberia, of course, has been the hardest hit financially. Tax revenues down there are down by about $62 million. Now, that's the impact in terms of numbers. What is it really like on the ground? Angelo Coppola has been in Monrovia for the last couple of weeks. He tells us what it's like to do business in the capital in the midst of the worst Ebola outbreak on record.
Flying into any of the three countries may be a bit of a challenge, as not many airlines are still on these routes. This is despite what the International Air Transport Association and the WHO are saying, that there is low risk of Ebola being spread in the air. On arrival in Liberia, for instance, officials quickly inform you to queue before entering the customs hall and baggage claim. You have to wash your hands and you have to have your temperature taken. Once you're over this initial rude awakening, it's all about managing your risk. In many instances, the risk is managed for you, and it applies to everyone, from government ministers to visiting international dignitaries. Doing business in Liberia and any of the affected areas in the West African region is going to be a challenge, but if you take precautions as you're instructed to do when you arrive here, very simple things like washing your hands, using the right ingredients here to actually make sure that you stay clean, dipping your feet in the little chemical fluid, staying where you are, getting your temperature checked. You're probably going to do all of these things at least 20 or 30 times a day. Doing business in the formal sector is also about precautions. When meeting government officials, it's not about the security, unless of course you're meeting the president or vice president. It's about washing your hands and having your temperature taken. Then your bags are searched. However, in the informal sector, it's a slightly different story. There are no buckets of chlorine water, tissues or thermometers. There's lots of body contact and perspiration. And while many people have moved to a new type of handshake, the locals who know each other aren't as fastidious. In the business environment, it's all about profit and loss, but it's also about managing your risk. And if you take precautions and avoid risky areas, there's business to be done here. However, you've got to do your research. Then you can make informed decisions that are based on fact, not on fear. I'm Angelo Coppola for CCTV in Monrovia, Liberia.
And he joins us now live from the Liberian capital of Monrovia. Angelo, you've been in Liberia for a couple of weeks now, and I guess the question a lot of our viewers will probably ask you is, what motivated you to go there?
Well, Raman, it's a very simple story. Ebola and where it struck was a key driver for me, because I didn't know anything about the West African region, and the only thing I knew about Liberia was the fact that Nicolas Cage acted in a movie around mercenaries, and it was around the city. So that's where my limit of my knowledge of the area sort of started, and I decided it was time to get in there because it is an important story for the continent, and also I wanted to see how the aid agencies are working on the ground. I consider the Ebola story in these three countries to be amongst the top 3 stories on the African continent, and that's a story that has to be told. Raman?
Indeed. You've covered some of the challenges in operating in the midst of ground zero for Ebola, as it were, but what other issues did you face in covering this epidemic? Talking to people, getting authorization from authorities, what sort of issues did you run into?
Raman, it's quite interesting because I think our predecessors who were on the ground here when all hell broke loose in June probably sort of settled ground for us here, because when we came in, the interactions with the ministers, with their spokespeople, with the aid agencies were pretty smooth and organized because, of course, the Ebola numbers were coming down. The biggest issue we faced was we couldn't just simply plonk our camera down in the middle of a street and start filming, because there'd be somebody's shop that you'd be filming. So we'd have to go and have a negotiation with the owner of the shop, explain to them what we're doing, get their buy-in. And as soon as they understood what we were doing and who we were doing it for, they kind of said, absolutely, please proceed. There were big smiles, and that was basically it, right?
Indeed. Angelo, at the end of the day, though, there's been a lot of concern about the ethics in which, the ethical nature, if I may put it that way, of the coverage that's come out of these core countries, Liberia, Guinea, Sierra Leone. Based on your time on the ground in Liberia, what needs to be done to improve the quality of coverage coming out of these 3 core countries?
Well, I can speak for Liberia, and the first thing that struck us when we got here, because on day 1 we went straight into a ministerial briefing, is the media, the local media. They're very vociferous, but they're also very tightly controlled by the government. We heard time and time again about the rules and regulations and the fact that journalists and media should be reporting openly and honestly, or face the fact of being arrested if they were seen to be inciting any kind of movement. And this is only on the political side of things. It was quite interesting. As international media, we could report on the sub judice cases like Executive Order 65 and the other challenges in the court. The local media weren't allowed to report on them. And in fact, they were coming to us, checking with us what was going on and what we were hearing. So I think what I'm suggesting is that perhaps if the country or the government wanted to get more balanced coverage, they should be allowing the media to do what they do in any free democracy. Raman?
Indeed, we'll have to leave it there for the time being. That's Angelo Coppola live in the Liberian capital of Monrovia. Now, we're still in West Africa. Long queues may soon be back at petrol stations in Nigeria, given a strike by the country's oil workers' unions. Members of the Petroleum and Natural Gas Senior Staff Association of Nigeria went on strike on Monday, and panic buying is underway in some cities in Nigeria. Consumers are anticipating fuel shortages over there. As Deji Badmus reports, the unions are demanding a reduction in pump prices and the passage of the petroleum industry bill as well.
For now, everything appears normal as petrol stations are still dispensing fuel, despite the strike called by the Petroleum and Natural Gas Senior Staff Association of Nigeria, PENGASN. But the situation may change dramatically should NUPENG, the Nigeria Union of Petroleum and Natural Gas Workers, decide to join the strike. The reason is simple. Members of NUPENG are mainly tanker drivers who supply petrol to filling stations across the country. Should they withdraw their services, the petrol stations will run dry and scarcity will set in. Head of the Lagos Zonal Office of NUPENG, Tokunbo Korodo, says it's only a matter of time before his union joins the strike, unless their demands are met.
The first thing is we are seeking for the urgent passage of PIB bill. It has overdrawn, and we believe the time is no longer on our side because the industry is going down. Most of the multinational companies are now ready to be in business with us.
Experts believe the petroleum industry bill holds the key to badly needed reforms in Nigeria's oil industry. But the country's parliament has been haggling over the details of the bill for a very long time now.
The PIB holds the ace when it comes to oil and gas development in Nigeria. It has been hanging for more than 6 years, and it's been discouraging investors. Even the traditional business friends, the international oil companies, are cleverly divesting, especially Shell, under the guise of encouraging Nigerians to take over in line with the local content law.
But beyond the PIB, the unions are making several other demands. They say they want the country's aging refineries fixed and a cut down in domestic pump prices in line with falling global oil prices.
The refineries to us, we believe, is because of lack of crude oil. That is why it has been abandoned. But now we have crude oil. I don't see any reason why we should not be producing.
The refineries are operating at very minimal capacity. Those that were even given private sector licenses, 18 of them, none of them has even done front-end engineering, let alone get into what we call FID, Financial Investment Decision. What we should be doing is that the Labour Congress or Union, the NUPENG and PENGASN, and interested labor organization should go beyond calling the workers out on strike. They should help this government by submitting a new template that they feel is correct and will lead to development.
The unions say the only language the government understands is strike. Meanwhile, the country's oil monopoly, the Nigerian National Petroleum Corporation, says it's in talks with the unions and has assured that petroleum supply and distribution will not in any way be disrupted by the strike. Deji Badmus, CCTV, Lagos, Nigeria.
Commodity prices, all of course, is one of the key determinants of all the bloodbath that you did see earlier on with regard to some of the commodity, the equity markets across Africa. Crude oil, Brent crude in particular, 59.04 is the relevant number that we're seeing here. There's a bit of a flight to safety to gold. Not exactly certain how long that will last, but we're certainly keeping tabs on it for you right here. 12.973 is the number. Coming up next, we'll introduce you to a Guinean innovator who's using regular, everyday materials to power up his neighborhood. Welcome back to the program. Let's take you to a small little room in an impoverished corner of Guinea's capital, Conakry, where a young innovator is using fairly common everyday materials to try and solve a major problem for the residents of that neighborhood. In Grassroots tonight, we'll introduce you to Mamadou Colon. He's devised a way to tackle a lack of electricity and soaring power prices.
26-year-old Mamadou Colon runs his workshop using his own generators. Tired of electricity shortages, he figured out a way to generate power using wind energy from makeshift turbines that tower above his informal settlement.
What's important is to show that there is a possibility of generating electricity easily without having to spend too much. This engine, for example, consumes relatively less than its output. This is what wind energy is all about.
The generators use recycled materials like wood, old battery packs, and are run by bicycle wheels, producing between 400 and 700 watts of power. He's been working on this project for 10 years and has finally won over some people in his community.
He has evolved from building turbines and installing solar panels in one part of the village. Having witnessed lack of electricity in Conakry, he saw it necessary to come here and help populations meet their electricity needs.
Colon would like to see his innovation adopted by many more people in Conakry as an alternative but steady power supply. Valdi Carolsa, CCTV.
Mondays, some of us don't like them, some of us hate them, some of them loathe them. But for a lot of us, it may have seemed like just another Monday, the 15th of December, that is. Unless, however, you happen to work in the shipping industry. With Christmas just around the corner, FedEx said on Monday, December 15th, that was the busiest day it's ever had. By its end, a record 22.6 million packages were shipped, and that's more than double a regular day's cargo traffic, most of it due to online shipping. FedEx had hired an extra 50,000 seasonal personnel to manage the workload. Worldwide, the company has roughly 100,000 trucks and over 650 planes delivering packages around the world. Some interesting numbers all around. Let's make a quick run through currencies here for you. The Kenyan shilling, not much going on that front. 90.55, 65. Pretty much the same numbers we've seen on Monday, and of course at the close last week. Remittances providing some support over there. The Naira, however, 1% lower despite central bank intervention to 180.5 to the dollar. The interesting bit, however, overnight lending rates in the interbank system in Nigeria spiked a new record, 80% in total. Now, in tomorrow's program, we'll be looking at Ethiopia's debut Eurobond. 200% subscription is the number that we're working with for that particular issue. We'll have the details, of course, on who's buying it and why. We'll also have an eye on the ongoing fuel worker strike in Nigeria. There are fears that more fuel stations will run out of gas as the strike does continue. As we've been reporting over the last 2 days, quite a bit of panic buying has settled in indeed. Now, that's it for this edition of the program. Do send your feedback to Global Business Africa at cctv.com. And of course, when we're not on air, Facebook and Twitter are your ports of call. We'll see you in the next 23 hours. I'm Ramanya.